Think the stock market is a fast track to getting rich. It can be, or it can turn your savings into a very expensive life lesson. In this video, I'll break down the different types of investments and explain how they make you money in layman's terms. Stick around, because understanding this could literally be the difference between building wealth and building character. First up, individual stocks. Buying a company's stock means you own a slice of that business. Kind of like buying a tiny invisible table at a restaurant you hope stays popular. Depending on the type of stock, you can get the right to attend shareholder meetings or even vote. Enjoy the responsibility. You make money two ways. One, if the company's value goes up, the stock price rises, and you can sell your shares for a profit. Two, some companies pay dividends, which is a fancy way of saying they hand you cash just for holding their stock. Bought Amazon in 2000? You're probably rich. Bought Blockbuster in 2000? You learned a valuable and very expensive lesson about nostalgia not being a business model. Next, ETFs, or exchange-traded funds. Imagine a basket full of different stocks, sold as a single item. It's like a trail mix for your portfolio, some healthy almonds, a few sweet raisins, and the occasional rock you didn't notice. You make money with ETFs the same way you do with individual stocks. If the overall value of the basket rises, your investment grows. Some ETFs also pay dividends from the stocks inside, so you might even get a little cash bonus while you wait for capitalism to do its thing. An S&P 500 ETF, for example, spreads your bet across 500 giant US companies, meaning if one or two blow up, the rest hopefully keep the party going. ETFs are generally a safer bet, but remember, you're one economic downturn or recession from losing it all. Now mutual funds, similar to ETFs, but with a twist. Someone else is actively picking what goes into the basket for you. Think of it as hiring a professional grocery shopper who charges you a fee and may still come back with nothing but kale. You make money in mutual funds through price appreciation when the value of the fund's investments rises, and sometimes through dividends or interest payouts. The catch? Fees. You pay them to the fund since they're doing the work, regardless if it is performing or not. In addition, you're surrendering control of your investments to someone else. Some managers do beat the market. Others, statistically, would have done better guessing stocks based on fortune cookies. And finally, bonds. Not exactly stocks, but close enough. A bond is basically a loan you give to a company or government. They promise to pay you regular interest, called a coupon, and then return your original money after a set period of time. You make money by collecting those interest payments and, assuming they don't ghost you, getting your principal back. Bonds are generally safer than stocks, but don't offer the same potential high returns. Government bonds are considered reliable. Corporate bonds can pay more, because corporations sometimes have creative definitions of the word stable. However, if the company or government goes bust, so does your investment. So quick recap. Stocks profit from price increases and dividends from a specific company. ETFs profit from diversified price increases and sometimes dividends of multiple companies. Mutual funds profit if your expensive grocery shopper picks winners. Bonds earn steady interest and pray you get your money back. Each investment type has its perks, risks, and learning curves. Diversify, stay patient, and most importantly, invest like you're building a future, not buying lottery tickets with a better marketing department.